Welcome to the Mentor Podcast, where the most highly motivated entrepreneurs come to get their weekly dose of financial stability with host Ron LeGrand, as well as other nationally recognized thought leaders who will teach you how to get, grow, and protect your wealth.
Hello, everyone. Welcome to another edition of the MentorPodcast.com. Got a very special guest for you today, especially if you want to grow wealthy tax-free. His name is Nate Hare, and he's in the business of helping you set up a IRA and other pension plans and use real estate to leverage your wealth without, taking risk, without borrowing money or any of that, like I teach. So if you've been to my training, then you must add this to it, because this is the vehicle that will let you grow wealthy tax-free. So I'm going to give all the time up to Mr. Nate Hare and let him explain it to you. And this is a very important lesson. So take copious notes and make sure that anybody you love gets this same message. Take it away, Nate. I'm going to give all the time to you.
I have been around self-directed IRAs for about 12 years. Before that, I got into real estate. So pretty familiar with how self-directed IRAs work. And I'm familiar with how Ron LeGrand students like to do investing. And quite frankly, those two powers together can really create yourself tax-free wealth for a lifetime. So stick with Ron, stick with us, and we'll try to get you guys to the end of the road here. Everything I present here is always going to be for education purposes only. You guys get that. I'm not giving you tax, legal, or investment advice, but we'll touch on some different areas about self-directed IRAs that hopefully will move you to get them set up, because I will tell you, and Ron will tell you, if you don't have some sort of tax sheltered plan, investing in something, you're really going to try to spinning your wheels trying to get to retirement, paying old Uncle Sam on every dollar you make. So self-directed IRAs are probably the greatest way to either defer or, even better, eliminate taxes from your real estate investing. And I will tell you, any investment strategy on the planet when it comes to real estate and retirement accounts fit well together. So I'm going to just talk about a little bit about the plans, the different plans that you can self-direct, why you'll want different plans, the pros and cons to each plan, because most people need more than one plan when you talk about self-direction. Now, when we're talking about self-directed IRAs, just be aware, self-direct is just a marketing term, guys. It's not a special type of IRA, right? When we talk about traditional IRAs, Roth IRAs, SEPs, SOLOs, HSAs, ESAs, they're all governed by the same set of rules. You can have those plans at Fidelity, and you can have those plans here at Directed IRA. We're both licensed custodians. We can hold assets. The difference between a Fidelity and a Directed IRA, however, is we hold different types of assets. Fidelity holds your traditional investments like stocks and bonds. Directed IRA holds your non-traditional investments, which is everything outside of Wall Street. The most common investments that we hold here are things that have to do with real estate. We have 17,000 clients. Most of them have their IRAs that own rental property, fix and flips, land, promissory notes secured by real estate, investments into syndications that might own apartment buildings and other types of multifamily. But anything you can hold title to can be owned in a retirement plan. But when you want to own things like real estate, you can't do it at Fidelity, not because it's against the rules, because Fidelity won't allow you to do it. Okay. So when you're investing, you got to remember that self-direct is just a marketing term. We hold the same types of plans that you can find anywhere else, but we'll allow you to hold different types of investments. Now, I'll just shoot straight to the point, guys. If you are investing in real estate, right, with strategic, creative strategies that allow you to buy either property at a discount, property on terms, property that appreciates and gives you cash flow, if you put all those things together in a tax-exempt retirement plan, don't do that in a traditional IRA, guys. You're going to end up paying taxes on every dollar that IRA makes. You just don't see it until you take distributions later in retirement. So if you're going to take a small amount of money and make it bigger, take that small amount of money, pay taxes on it first. Make sure everything that you invest in, and this isn't investment advice, it's just real life. Make sure if you're investing in things that go up in value and have multiple income streams, do it in an account that you've already paid the taxes on. That's why it's so advantageous for everybody to look at the Roth IRA. Roth IRAs are the sexiest things on the planet, including Roth 401ks when they own real estate. And I'll tell you why. When you have a Roth IRA, whatever assets are in that Roth IRA, you, as the Roth IRA account holder, get to take what's called qualified distributions. Once you've had a Roth IRA for 5 years, or you're above the age of 59 and a half, what happens at that point is you are allowed to take what's called qualified distributions, which are tax-free and penalty-free for the rest of your life. So let me give you a real story about a Ron LeGrand student I've had for many years. He's acquired 12 rental properties, right, through a land trust, and his land trust, the beneficial owner of the land trust is his Roth IRA. So ultimately, these 12 rental properties are owned by a Roth IRA. He's above the age of 59 and a half. He's had the Roth growing for more than 5 years, so he has qualified distributions. Every month, the renters of those properties pay rent, right? Well, ultimately, are the benefit in his Roth IRA. Not him. He doesn't own it personally as the taxpayer. He doesn't own it in his personal LLC. These are owned through trust owned by his Roth IRA. So roughly every month, he gets about $20,000 of rent that are deposited into his retirement plan, which are qualified distributions. He takes a distribution of those rents of about $20,000 a month, and he pays no taxes on that distribution. The next month, rents come in, he takes another distribution of $20,000. Long story short, guys, he's taken roughly $240,000 of tax-free, penalty-free distributions by owning rental property in a Roth IRA. Here's the most interesting thing about it. Every year when we get his account statement or get his fair market value, his account goes up in value because all the properties are appreciating over time. He's not tapping into the principal. So if you can start today, or if you've already started, good for you. If you can start to accumulate assets in an account that will never be taxed, like a Roth IRA or a Roth 401k, you can live off the grid legally without escaping the country and going to another country and hiding out. You can live off your Roth IRA. And I think that's the end goal for everybody. Get to a point where your real estate assets are accumulating income or appreciating over time, and you don't have to pay taxes on that money ever again. So you want to think about that. And if your CPA, by the way, tells you that you make too much money to have a Roth IRA, fire them and call me. I'll find you another CPA that understands the rules. So if you're investing in real estate with Ron Strategies, make sure you do that in a Roth IRA. Or if you're self-employed, a Roth 401k. We'll talk a little bit about that as well. Don't forget about the other plans that can be self-directed as well. We have plans here at Directed IRA that can also be self-directed, okay, in the same types of investments with the same types of strategies, but they're not retirement plans. These would be plans like your self-directed health savings account, or if you've got kids or grandkids, your self-directed Coverdell education savings accounts. I've got slides on this, but I can email it everybody if you want. These are plans that can be self-directed, but you don't have to wait for 59 and a half to take the money out tax-free and penalty-free. As long as you're self-directing a health savings account or an education savings account, the income from those investments can be taken out immediately, tax-free and penalty-free, to pay for all your qualified health expenses and all your qualified education expenses for your kids and your grandkids. So if you really understand how these plans work, not only can you set up tax-free income for yourself in retirement, but you can pay for current expenses when it comes to healthcare and education completely tax-free. And if you're using them all together, more power to you. So we can take questions about the account types here in a little bit. I've got slides, and I'll email this. Actually, I emailed it to Nikki. If you want to just send that to everybody so they have the slides.
Oh,
perfect.
Okay. We'll
Yep.
do that.
Yep. So now what types of strategies do we see Ron LeGrand students make? I see clients of ours do subject to very, very common investment strategy. I think that's very well. I have one off the top of my head, just to give you another example, because I love stories. I have a client that started buying property subject to in his Roth IRA back in 2012. The reason why subject to I like in a Roth IRA is because it takes very, very little out of pocket to take title to a property. And I'll tell you, this client only started with a $70,000 traditional IRA when he started self-directing back in 2012. He had that from a rollover from the old company that he worked at, which was Motorola. Now, fun fact for you guys, what he did with that traditional IRA is he did what's called a Roth conversion. If you have a traditional IRA or a pre-tax account, a Roth conversion is an opportunity anybody can take ever since 2010. There is no income limit. Let me repeat, no income limit to convert existing traditional IRAs to Roth IRAs. Okay, so if you've got a traditional IRA now, think about paying the taxes on it and move it to a Roth before you start investing. This is what this client did. He paid taxes on 70 grand to convert his traditional to a Roth. Then he went out and he started looking for property that had little to no equity, expired MLS listings, and the owners were in distressed situations. They either couldn't pay their property taxes, they had lost their job, and he was finding quite a few of these. Now, the reason he was finding quite a few of these is because all the beginning investors were passing on these deals because they were so narrow focused on how they personally make money on a property with no equity. They passed on the deals. They said, sorry, I know you're facing foreclosure, but I can't help you. There's no way for me to make money on these deals. My client, our client, decided, well, that's not an investment that I would do personally, but these actually would fit great in my Roth IRA because I can put these investments on the shelf and let it ride. So what he ended up doing is he started negotiating terms to take over the existing mortgage payments, or in this case, his Roth IRA would take over the existing mortgage payments, patch up the past due mortgage payments, and even give the homeowner some cash for keys so that they can walk and he can get this property rented. So with that $70,000 and that strategy, he was able to pick up 5 properties over the next 5 years. Okay, very little out of pocket, but he takes over title to a property. What he did immediately from that point is he got his property manager to manage it. Property manager rents everything, pays the mortgage payments, and on he goes. Fast forward in time, these properties have been rented, but remember who owns it? His Roth IRA, not him. In about 2 years' time, he told me he'll have all of these properties paid off and owned free and clear in his Roth IRA when he's 59 and a half. Remember what he started with, 70 grand in a traditional, and now he's moved everything to a Roth IRA where the notes have been paid down. Thank you, renters. Okay. These properties are all owned in Austin, Texas. Okay. Roughly, his Roth IRA will be worth about $4 million because that's what the properties will be worth. Now, you guys tell me, since he paid the taxes on 70 and he grew it to 4 million in a Roth IRA, how much taxes does he pay on those gains? Nada, zero. So that's how you should be looking at deals. And knowing that sometimes your radar needs to be expanded because sometimes deals that don't work for you personally might fit wonderfully in a Roth IRA if you can put it on the shelf. Okay, that's just one example. I have another Ron LeGrand student. If you don't even have 70 grand, I have a Ron LeGrand student that used $6,000 to buy 3 warehouses in Houston with seller financing from a widow who inherited the property. The husband was managing the property. Husband died. Wife took over. Wife was in her 80s. Wife didn't want to deal with the tenants. Tenants started abusing her kindness and weren't paying. So our client stepped in and said, hey, look, I've got a little bit of money in my Roth 401k. I know you don't need the cash, so I don't need to buy this cash. But how about I give you a little bit of income on this property and you don't have to deal with the tenants? She said, well, that sounds wonderful. I don't want to deal with the tenants, but I like the monthly income. So what he ended up doing is he structured a deal on terms where his Roth 401k gave a measly $6,000 as a down payment. And the Roth 401k carried back a note from the widow for about $94,000. Same thing, puts it on the shelf, rehabilitates the tenants, gets his property manager in place. Now he's got 3 paying tenants on 3 warehouses. Fast forward in time, one of the tenants wants to buy warehouse number 3. Okay. He sells, or his Roth 401k sells warehouse number 3 and makes enough money to pay off the note to the widow. And today he retains 2 warehouses cash flowing and that are worth about $100,000 each. And that is all done in a Roth 401k. And he used $6,000 to do it. So there's a lot of power in using strategies where you're buying property on terms, but doing it in an account that will never be taxed. Do not do those strategies in a traditional IRA because trust me, the IRS likes it, but we don't like it as investors. So those are just some of the main points of things that you can do. I'll take questions here in a second, but the other thing that I want to do as well is if you guys are active real estate investors, which I assume most of you are. The more you understand about how you can self-direct your own plans will unlock the other side to self-directed IRAs that I see so powerful when you're a real estate investor. And that's the ability to use private capital from other people's retirement accounts. We call it OPI, not nail polish, Nikki, other people's IRAs. There's now, at last time I looked, over $38 trillion in US retirement plans. Most people that have that money do not know what to invest in. They're not taking Ron LeGrand courses. They work 9 to 5 jobs. In fact, of the 17,000 clients we have here at Directed IRA, I would probably say only 10% of those people are active investors that do it for a living. Most of our clients here at Directed IRA, including me, like to invest their retirement plans passively. They do it through promissory note investing, hard money loans to real estate investors, flippers, or they're investing their IRAs passively into things like syndications, apartments, multifamily, commercial. If you understand how self-direction works, you'll be able to tap into that bucket of money seamlessly. You don't need good credit to tap into it. You just need the ability to make some relationships and the ability to make it smooth and painless on your investors. And the way to make it smooth and painless is to have your own self-directed IRA. So there's two things you want to think about when you think about self-direction. What are my accounts doing? Okay, and how do I grow those for long-term generational wealth? And then how do I make money today, okay, by using other people's self-directed IRAs as a private capital source? Because one of the things you're not allowed to do is you can't tell your IRA to invest in your own deals. The IRS doesn't care about what we invest in, but the IRS does care about who our IRAs invest with. So I'm sure most of you guys know that you can't self-deal your own IRA to yourself, but that doesn't prevent you from borrowing or leveraging other people's retirement plans to buy all the real estate you want, and you don't have to walk into a bank to qualify for that. So look in the room. You guys got private lenders sitting right next to you. As long as they're not related to you, you guys in that room can really create your own private bank by leveraging each other's IRAs if you want to go buy all the real estate that you want.
All right. Well, thank you, sir. That was a lot of information you just covered, a lot of valuable information. Now, if anyone listening wants to get the slide deck of what Nate covered here, just send your name and email address to podcast@ronlegrand.com and we'll send you the slides. That's podcast@ronlegrand.com. And you must put in there now that you want the IRA slides so that we'll know what to do. And so that's it for today. Thank you for watching. You can follow me on Facebook, TikTok, YouTube, and plenty of other channels out there, Instagram, anytime you're looking for me. So thanks for watching. I'll see you in the next podcast.
That's all for this edition of the Mentor Podcast. To connect with Ron and learn how you can attain financial freedom, as well as up-to-date strategies to grow and protect your wealth based on today's discussion, go to www.connectwiththementor.com.